Today is August 13th. It is Tuesday. Market movers today. Just looking at some technical things, we had retail sales up 0.2%, not a big deal. Market opened down a little bit on that, but it's rebounding. We're only down a couple points on the S&P, so not a whole lot of activity based on that retail sales number, although it should be seen as more important. If you recall, the June number was pretty ugly, 0.1%. That was unexpected, very weak. A lot of people thought that was an anomaly and that it would bounce back. Unfortunately, it was not an anomaly, apparently, according to what we had for July, 0.2%. Not much better, and certainly not a big revision to the June number. So whatever people were thinking would happen with that number didn't happen, but yet the market only reacted a little bit off the open Dow, down about maybe 40 points. The NASDAQ was off a little bit more than that, but again, we've rebounded, and now we're only down maybe a couple points on the S&P. At least at this point, it's about 8:45 a.m. So still a lot of trading left to do in the day, but again, we're not seeing the kind of negativity, I guess you would say, or the kind of more marked reaction by traders or investors to these data points that come out. One other quick thing I want to mention is the Hindenburg Omen. This is kind of a funny thing. The Hindenburg, obviously, it's a reference to the airship that crashed in the late 30s in New York. It's an indicator for market crashes. And just to give you some recent reference points, we had a bunch of there's several indicators. It's not just one thing, but it has to do with market volatility and specifically with new highs and new lows. A lot of ratios relating to the new high, new low ratio that give these Hindenburg Omen indicators. But back in May, we had the May 22nd all-time high set, and then the market started to sell off. Around May 31st on Friday, we saw these Hindenburg Omens hit, and one of them is the ratio of new highs to new lows. There are fewer new highs than new lows. So if you get, for example, more than 2.2% of the total companies that trade on the market that day on each side, in other words, more than 2.2% of the total companies traded that hit new highs, and more than 2.2% of the companies traded that day hit new lows, but the number of new lows is more than the number of new highs, it triggers this Hindenburg Omen as an indicator of a possible market crash. Now that day there were 156 new lows and there were 76 new highs. I believe that's a number. What do we have? We have 156 on the new lows and 90 new highs. Sorry about that. So 156 new lows to 90 new highs. So a lot more lows than highs. And both of those, obviously, numbers were bigger than the 2.2% minimum threshold. That day, the market, the S&P was off about 1.4%, and the market did end up correcting down about 7.5% from that May 22nd high to the recent bottom. From that point, though, it didn't crash. Obviously, a 7.5% decline is not a crash, and the market rebounded and actually set even higher all-time highs after that. Now we're starting to get more of these Hindenburg Omen ratios, indicators that we could be in for market crash. We also have a lot of pundits starting to talk about 1987 style crashes, so definitely some concerns about the inner workings of the market, the technicals, the chart patterns that we're seeing, and a lot of the volatility measures like the Hindenburg Omen. So we need to keep a close eye on that, and certainly want to make sure that that we, if there's a way to foresee a major crash, that we're aware of that and we're staying on top of it. As you know, I'm mostly in cash right now, expecting a correction, which I have been for quite a few months. But I'm definitely in position to take advantage if we do have a major correction or a crash, which is what I would do. Stay tuned for more.